Today we are looking at my absolute darling sweetheart of a dividend pair, Legal and General. I know for many of you it is part of your portfolio. It is an absolute solid rock in the stormy weather that is the current economic climate. And I'm sure you've all grasped from the thumbnail that it's £2.47 a share, market cap of 14.7 billion. And it's down about 8.6%. Has rallied somewhat in the last week of 5%. I'll be looking more into that. Ticker symbol LGEN on the London Stock Exchange. One of the most well-known dividend pairs out there. Scoring 6 out of 6 on the analyst checks on Simply Wall Street. And 6 out of 6 in company evaluation. Now, we'll be getting right into the nitty-gritty. I love this company. Full disclosure, I own shares. I'm going to try and not be biased and just look at the numbers. But again, their dividend track record is nearly unmatched by any other UK company. So we'll be looking at that. Okay, so let's get some of the good stuff first for you. It's trading at 62.5% below their estimated fair value. Now, Simply Wall Street use a discounted cash flow model. Hence the word model. So take it with a pinch of salt. Earnings are forecast to grow 5.24% per year. They grew 11.9% over the past year, and their high reliable dividend is yielding 7.79%. Sometimes when it's a wee bit down, especially at the start of the week, it was actually closer to 8%. They're currently trading at a good value to peers in industry, and analysts are in good agreement it will rise by about 22% in the near future. Risks, it makes less than 1 million in revenue. Again, once you see the model of this company, it's in the insurance, it's in the investment management, so its balance sheets are a little bit more complicated to read and look at, and their projections are also a bit skewed just because of it. When you respect that is indeed, the industries they operate in, like insurance and investment management, you can give them not a bit of a pass, but it's not as easy to read as, say, a mining company. Gold's up, this is the price, their revenue's through the roof. High level of debt, well, at a company this size, it's to be expected. Again, a different beast of industry. Profit margins are 20% lower than they were last year. Again, things to consider. When it comes to their competitors, up there would be the likes of Prudential and Admiral Group. Now, Admiral Group, of course, being another insurer. As is Prudential, are they the investment management? I'm looking at them next, so I'll get to learn that in a bit. But I definitely know they're in the same ballgame as Admiral Group for one of their divisions anyway. I know one of their divisions is probably larger than, they are market cap, larger than Admiral, smaller than Prudential. When it comes to their price and performance over the last year, as you know, they are down low point £2.4, high point £2.86 or £2.84. They reckon a lot of analysts and a lot of articles you'll read, if you see their price between £2 and £3, it's a good day all round. Now, let's bring this chart out and look in the last 5 years to give us a bit of a more complete picture. You could have got them for £1.39 back in March of 2020. All of us know infamously what happened there. They were trading at nearly £3. It must have been pretty scary to see your, investment in this company halved by obviously COVID. But it rallied back, end of March and April, and it's come back in the last while. Simply Wall Street gives you a really cool user interface. You can see here all the green dots are dividends. Anything financially related is purple, and clicking into it, it can give you articles. Now, some of them are basically generated articles, but some are by humans. So, it's always a good wee thing to read into. For example, here, Money Hub Financial Technology announced it received 50 million in funding from Legal and General, Lloyds, and Phoenix Group Holdings. Let me see, management, wee one popped up. Sir Nigel Wilson plans to retire as chief executive of Legal and General. Okay, we'll see how long he served and have a look more into the management later on. Now undervalued, 23% back in March there. Now, when it comes to shareholder returns, Legal and General last 5 days is set up 5%. Over the last year, the market's down 4%. Legal and General and insurance hit a wee bit harder. Not unrecoverable, but it's something to notice. It's not the most volatile in terms of price volatility in a market, but it's definitely not nothing. You know, it can go up and down, as you can see, 8.6% in the last year. I know healthcare REITs and other industries were hit far worse, so that's something just to bear in mind. About the company, now it's a long spiel. I'm only going to do the first paragraph. Feel free to pause and read the rest. But they provide various insurance and services internationally, United States, UK, in 4 segments. This is a key part. They have the retirement institutional, LGRI, legal and general investment management. You'll actually see them quite a bit in the channel down at the ownership tab of a lot of companies. Legal and general capital, and retail retirement. So yeah, that's where a lot of their, both insurance and a lot of it is wealth management. So yeah, you can read into all of the services they provide in each segment and what they do. It is vast. But I'm looking mainly at the financials today, so let's carry on. Pay ratio is 6.4 and a price to sales ratio of 1.3. Okay, well, we'll bear that in mind as we continue on. We can see that's pretty scary. Revenue down 10.89 billion. But is that the complete story? Their next earnings call is August 15th. We'll see how the last year has really went for them. Obviously, with interest rates and many other economic factors across all of their segments, it's hard to know, but we'll be staying tuned for August 15th. I would highly recommend you throw that in your calendar to see how they've been getting on. Debt to equity ratio, again, another scary 618%. But again, is that the entire story? When it comes to their ex-dividend date, as of today, it's April 12th. Their ex-dividend date is April 27th, which means you would need to buy the share by April 26th. I just want to make that, clear to anyone. Obviously not recommending you go buy the shares. I'm just saying that you need to own it a day before, as opposed to the 27th, in order to be entitled to the next payout, which is June 5th. I think I'm getting about £44. I hold about £700 in legal and general, just to give you a bit of an idea of what 7.8% yield looks like. If you want to know more, be sure to check out my portfolio videos. Down to valuation, 6 out of 6. They blaze across this. Let's see, when put up against Prudential, down at 6.5% or 6.5 times, as well as Admiral Group. You could add up peers. Maybe you want to compare them more so to maybe like Lloyd's and Phoenix Group Holdings, as was mentioned earlier. If you feel they'd be better peers to compare, it is great through Simply Wall Street that you can do all of that. You can change all the metrics. It essentially gives you the tools to look at what metrics matter to you. What do you want to see? Do you want a good price to earnings ratio, price to sales, price to book? Do you want to just see everything about their dividend, their future growth? It's all here, and it is great. And a complete shilling point. You get 40% off if you use my code, first 100 people. So feel free, it's in the description. On to future growth. They are 5.2%. Earnings growth and a 3.8% EPS growth, earnings per share. Pretty modest, but they are projected to explode, it seems. Revenue jumping from minus 10 to 101 billion. Now, for a lot of people, that seems completely out of place and out of the blue. But again, you have to understand that the segments they operate in is much more different to any of the other stocks that we tend to look at on the channel. In fact, even I find it hard to get my head around it, but given their dividend performance and given a lot of the other metrics, past performance, for example, before 2022, you can see that they were operating pretty modestly, about 22 billion back in June 2019, and their profit margin again remains between 7 and 10%. Operating expenses, it's not really highly detailed. Again, the financials are a little bit odd, and that's one thing that you have to understand for a company such as this. Down to financial health, though. Let's have a wee look. 101 billion in short-term assets and 115 billion in short-term liabilities. 411 billion in long-term assets and 385 billion in long-term liabilities. What do they score well on? Debt coverage and interest coverage, which is two of one of the scariest metrics that you need going well. If you aren't covering your debt or your interest rates, bad things happen very quickly. Now, again, 618% debt equity ratio, scary looking. Throw in their cash and equivalents, 35 billion, gets a wee bit nicer looking. Okay, so their debt coverage, well covered by operating cash flow at 27.3%, and interest payments, another important metric, is at 13.6 times coverage. Now, I obviously would be... See, I don't want to make the statement it would be nicer to see their debt equity ratio kind of shrink because, again, it's very hard to fully appreciate how a company like this and all their different segments operate. Perhaps this isn't as scary as it looks. And, well, considering they're covering debt and interest coverage, it's maybe not as scary. But could economic headwinds coming up change that? It's highly possible. Although the day that Legal and General cut or lower or don't pay a dividend, we're all in serious trouble. 7.8% yield, 51% payout ratio, 6 out of 6. Rare you ever see that metric. I think Assura and like two other companies in Simply Wall Street on the UK Stock Exchange have 6 out of 6 on all the metrics. Next dividend date, next dividend, we covered that. Industry average 4.4, so they're way ahead. Dividend per share, 19 cents or 19 pence. Cents? I'm not doing any US stocks today. Earnings per share is 38 pence as well. And it's actually forecast to grow 9.1% in the following 3 years. Their chart, again, back in 2012, you'd have got 67 pence per share for your dividend, and it was 4.7%. As of today, it's now closer to 20 pence. Oh, sorry. You would have got 7 pence or 6.7 pence back in 2012 as opposed to 20 pence today. Amazing growth. Earnings per share, again, also outpacing the dividend per share quite nicely. Earnings coverage and payout or cash payout coverage is very low. Their cash flow retained, it's only about 6%, 5.6%. Now, again, how this is all measured and all, put out is, again, very, very skewed to these industries and this particular company. But we'll move on to management. 6.1 years is the average management tenure. Nigel Wilson, who is retiring, compensation nearly $4 billion. Fair play, Nigel, there. We can see here, company earnings under his watch dipped during COVID, but again have recovered and seem to be quite strong. We can see here that the leadership team and board members' average tenures are also pretty decent. Now, I want to go down to ownership. A load of people have been buying shares here and there. Nothing over 40,000 recorded in the last couple of months anyway. Ownership breakdown, 79.9% institutions. Right. 17.5% general public and 2% employee share scheme. Now, you can tell by the general public's percentage, it is a beloved company in a lot of people's dividend portfolios. Top owners, BlackRock, Vanguard, frequently making the top charts. Columbia Management in third, and RBC Global Asset is down there. You can actually see their employee share scheme sits at 1.56%. Anyone else that I can spot just off the top here? Yeah, nothing too mad. 5.91 billion in shares outstanding, and you can see life and health insurance again is another massive segment that they have. It probably did detail it back in that other bit. Founded in 1836, a very, very old company. Website there. 11.5k employees, 6.9. So they've added 4,500 in the last 5 years. Pretty big employer. They're actually headquartered down in Greater London. Well, it says location. I assume it's the headquarters. Yeah, it actually is the headquarters. They were getting a real new fancy office. I've seen that at one stage. That seems pretty cool. And then their ticker symbol. They're also traded on the German stock exchange as well. Nice to see. Okay, well, that covers Legal and General. Let me know what you think in the comments below. Is it part of your portfolio is the question I'm asking today. because obviously I can't stress how beloved it is for its payout. I don't know how many years it has. At least the last 12 has been consistently growing, dividend payouts, and of course a very, very attractive yield. That's for sure. Continuing on, they'll be part of my own portfolio. Again, not advice, but that's my feelings on them. So I'll see you all in the next company overview. Thank you.